Hello, everyone. Hope everyone's doing well and enjoying their start to their summer. With all the headlines, wanted to take a minute just to quickly touch base, check in here on what's driving markets. As we've all experienced firsthand, inflation or prices on typical household items has continued to spiral out of control to record highs. As we've discussed, this has been a function of a very accommodative financial conditions. We had a lot of stimulus immediately following COVID. I've had low interest rates for a while. Additionally, with COVID, a lot of those supply chains, those manufacturers have not fully come back online. Less supply puts upward pressure on prices. Then also we saw a huge spike specifically in food and energy prices. That was following the Russian invasion of Ukraine. Russia is a very large oil or energy exporter. Ukraine is on the agricultural side. With that supply coming offline again, put significant upward pressure on prices. Earlier this year, we saw year-over-year inflation register at 8.6%. That is a 40-year high. Now, in April and May, we saw that start to improve, some very marginal progress there. The expectation was for that trend to continue, with forecasts for last Friday's inflation reading to come in at 8.1%. Instead, that returned to previous highs and offered a very sobering reminder that just because we want something to happen or the research suggests it will, doesn't mean that it necessarily will in the time frame that we would like. And the concern with inflation is if wages don't move in lockstep, consumers will lose their purchasing power and thus have to tap into savings or borrow, think credit cards, in order to maintain their current lifestyles, or they have to cut back and only buy those items, those necessary items that they can afford to. The cutting back is then the concern. If people are spending less or buying fewer items, that will ultimately slow the economy. That's what sparked a lot of those recessionary concerns. Additionally, the Federal Reserve, that's led by a gentleman, Jerome Powell, one of his two mandates is tasked with combating inflation or maintaining stable prices. And one of their primary levers in doing so is controlling interest rates. Now, Powell has come out and said they are willing to do whatever it takes to combat inflation. That has also sparked that recessionary narrative with the concern if they go too far, too fast. And a great example to illustrate that, if we think about real estate prices, mortgage rates on a 30-year fixed went up from earlier this year, right around 3% in a very short period of time to just over 5%. So if you think about a buyer that has $3,000 a month they can spend on principal and interest, if you think about a 30-year fixed mortgage rate at 3% annual interest, they could afford a house with that $3,000 a month payment of $705,000. If we keep everything the same, 30-year fixed rate, same $3,000 a month allocation, but interest rates are now at 5% annually, the amount of property, the purchasing power they have is now $553,000, almost $150K less. And obviously, again, if folks can now only afford to pay less for houses, that will eventually put downward pressure on real estate prices. So again, the challenge when we think about the Fed and their mandate, we want them to slowly reduce prices, but not to overdo it and push us into a recession. If they're able to do that, that's what's referred to as a soft landing, although it is very, very difficult to do. Now, over the intermediate and long-term expectations, with China lifting their COVID lockdowns, seeing a lot of their major manufacturing cities come back online, that will certainly have a positive impact on supply chains. I think that will put some downward pressure on prices. As well, any de-escalation in Ukraine would likely positively impact food and energy costs. As well, we do expect spending on some of those items, again, folks having to cut back a little bit, will eventually cure some of these higher prices. The saying is the cure for high prices is high prices. Again, the question ultimately becomes, though, when will this happen? When, assuming that it does, that will then give the Fed the ability to back off, and think that will provide a very sustainable risk-on environment. The question all comes down to timing. This is certainly something we will continue to monitor very closely, communicate as there are updates. Know that in the meantime, we certainly have positioned your portfolios more conservatively, meaning to better protect versus benchmarks on the downside. Now, granted, that's something we certainly wish we did much more of, but as I mentioned, are encouraged at some point over the intermediate and certainly long term. Do believe inflation will eventually trend in the right direction. That will provide a much more favorable backdrop or conditions where we think risk assets could likely recoup a good bit of the volatility that we've experienced thus far to date. That's all for now. As always, please don't hesitate to reach out with any questions. If we don't chat, have a great rest of the week. Take care.